Hello, everybody. Thanks very much for joining me on Monday. It's August 14th. Again, time just flies. August is whizzing by. Before you know it, it's going to be September, and then Halloween, and then Thanksgiving and Christmas, and then it'll be New Year's. So time flies when you're having fun, and we're certainly having lots of fun, or at least it's very interesting. If we didn't have skin in the game, it might be more fun in some areas. Right now, it's not much fun in the bond market, and it's a little less fun in the stock market, especially in the mega cap 8. But it's the nature of our business. Has its ups and downs. Here, weather-wise, we've had the dog days of summer in August. We've had some really hot days, but nowhere near as bad as some of you folks down south have had it. Speaking of dog days, we have a special treat here. We've got both Max and Bailey joining us, and so it's twice the snoring noise that you typically hear in the background. Bailey's become a big snorer. So, anyways, they're very comfortable, and they usually tend to sleep through the whole thing, or maybe if they wake up, they'll kind of walk out. But lots for us to talk about. The subject that I focused on in the morning briefing this week on Monday today is disinversion. I kind of wanted to put on a cardigan jacket like Mr. Rogers and say, "Hello, boys and girls. Can you say the word disinversion?" Well, what is disinversion? It's the opposite of inversion of the yield curve. Let's have a look at some of the charts that kind of will make it a little easier to plow through the whole concept here of inversion and disinversion. Let me share my screen with you. Let me just get to the bottom line here. The bottom line is there's really two ways that the yield curve can disinvert. We know how it inverts. What happens in an inversion scenario is that we see short-term rates going up, and at some point the bond yield gets the message that rates are going up, and so the bond yield goes up. But what tends to happen in an inversion is that the bond investors start to be willing to buy the bonds at a yield below the short-term rates. Why? Because they feel that if the Fed just keeps raising short-term interest rates, something will break in the financial system that will cause a credit crunch, and that will in turn cause a recession. So why not buy bonds here at 4.2% when short-term rates are around 5%? If you think that a year from now, 2 years from now, or over the next 10 years at a relevant point, it's better to lock in 4.2% than to bet that you're going to be able to get that kind of rate by staying in a 2-year that is more likely to go down than up. And besides, you make your calculations of what you need, and if 4.2% does it for you, and you're not, and you have an inflation scenario forecast, personal one, that you think is less than that, then it looks like a good deal. Of course, today we've got people like Bill Ackman, who believe that the yield for the 30 years is going to go up to 5.5%, and that's based on a view from what I read in his tweet that inflation is going to be higher than I'm thinking. But so here's the federal funds rate. We've had a dramatic tightening move. Let's turn from the federal funds rate to the 2-year, because the federal funds rate tends to be sort of a laggard. It's administered, it's determined by a committee, whereas the 2-year yield reflects not only where the federal funds rate is, but where it's expected to go. And it is really the alternative to the 10-year when we look at the shape of the yield curve. Obviously, there's other spreads that we could look at, but this one is the one that I tend to focus on. And as you can see, there's these red shades, which are periods of monetary tightening. That's when the federal funds rate bottoms, and then the federal funds rate goes up and peaks. The blue periods are when the federal funds rate peaks and then on its way down to its trough. And so we can, in one chart, see what the 10-year and the 2-year yields are doing relative to the monetary cycle as measured by the peaks and troughs of the federal funds rate. Obviously, there's other variables these days like quantitative tightening that are relevant, but I think this, for our purposes, this still works pretty well. And you can see that when you look at the spread between the 2-year and the 10-year yield, the inversion tends to occur as the short-term rate, the 2-year yield goes up faster than the longer-term rate, and as a result, you get the inversion of the yield curve. Let's look at that yield curve here. You can, again, relative to the monetary policy cycle, and you can see that the inversions occur as the Fed is raising interest rates. So during the red periods here, you get either an inversion or you get a dramatic flattening of the yield curve. And we've had a dramatic flattening and inversion of the yield curve in the current period of monetary tightening. Again, this was the bottom in the Fed funds rate, and now this is where I project the top is, which is right around now. So we know how it inverts. It inverts as long-term rates rise more slowly than short-term rates. It flattens, and then if the 2-year yield rises above the 10-year yield, it actually inverts. So we've had inversions, as you can see. And it's still widely believed that the inversions are a great way to forecast recessions. I've argued that what the inverted yield curves actually do is tell you when there might be a financial crisis that might lead to a credit crunch that might cause a recession. I mean, if you have a credit crunch, it's going to lead to a recession. So this time around, the yield curves worked pretty well. It told us that there was going to be a crisis. There was a banking crisis in March. And then a couple of weeks ago, Moody's reiterated that the banks have some serious issues. And I don't think that the Fed really wants to move interest rates any higher. I think they feel it's restrictive enough, given some of the clues that they're getting from the credit markets, that things are restrictive. And they're talking about leaving the Fed funds rate at its current level of 5.25 to 5.5%. The risk in that is that we get disinversion, and we get there's two scenarios for disinversion. The happy scenario for disinversion is that we get a recession, or we get disinflation, falling inflation. The best scenario is disinflation, obviously. That's the happiest version. But if we get into recession, then it's happy to see short-term rates come down as the Fed realizes that they've got a recession problem more than they have an inflation problem. Inflation also comes down. And then what do? They lower short-term rates, and short-term rates actually fall faster than long-term rate. And that's a relatively happy version. And that's kind of the historical version of disinversion. The other alternative is not so happy, and we really haven't had it. This would be kind of an unusual situation, and I think it's something that the Fed probably doesn't want to see happen. But the alternative, bearish, pessimistic, unhappy version of disinversion is that when you see the short-term rate go up, and then the Fed says, okay, we're going to keep it here for a long time, and people who bought the 10-year at 3.3% said, damn, I bought it too early. Here it is already at 4.2%. And then the people who are thinking about buying it for 4.2% say, what's the rush? If the Fed's going to keep the Fed funds rate at this level, and and short-term rates are going to stay around 5%, what's the rush to buy the 10-year? The only rush is if you think the short-term rates are about to come down. If they're going to stay up, and people are talking about a prolonged period of rates staying at these levels for quite some time, then that could start to push the 10-year yield up, and that's how you disinvert. So you go up to 5% on the, or 5.5% on the 10-year. And the problem with that, of course, is that one is we're seeing inflation coming down, which is what the Fed wanted to see. And I think we are seeing a credible moderation in inflation that is in fact on track to bring inflation down to 2%, not this year, not next year, but by 2025. So I think the Fed has achieved what it wants to do. It wants to get to a restrictive level that is going to bring inflation down. Now, we just had John Williams of the Federal Reserve Bank in New York do an interview with the New York Times that I picked up, and everybody picked up. Steve Leisman discussed it. And it's an interesting perspective. He says, look, John Williams said, I am a real interest rate man. I'm not a nominal interest rate. I don't just focus on nominal interest rates. And he was making the point that if inflation does come down and the Fed keeps the Fed funds rate where it is now, that becomes increasingly restrictive from a real interest rate point of view. And so it would justify lowering the Fed funds rate. Why is he coming up with this right now? Where's this coming from? I think they realize that if they get the disinversion with the bond yield going up, that could really put a lot of stress on the credit markets, could really cause a lot of problems for the banks. And certainly their loan portfolio, their bond portfolios would be worth less. I guess they could hold them to maturity, but it could create some uncertainty or anxiety among depositors about the health of their banks if they're sitting on tremendous losses in the bond market, which they already are. It's only going to be even bigger. But of course, a more immediate concern is if you keep seeing bond yields going up, mortgage rates going up, it could really flatten, it could really dampen the recovery in the housing market. But more importantly, it could really cause some real problems in the commercial real estate market, which is already in trouble. So there could be widespread defaults and all sorts of other problems. So I think the Fed would like to see inflation come down. And I think the fact that John Williams is talking this scenario suggests that he's coming around to believe that, you know what, maybe they're on the right track. So why blow it? Why not start to talk the markets down in terms of interest rates and say, if inflation keeps coming down, we're going to have to considering lowering short-term rates. And that would keep the bond yield from blowing out to 5.5%, the Ackman scenario. So, and by the way, that's a scenario I'm rooting for. I think that while we have this tension, this suspense of which disinversion scenario is going to play out, I think that's going to hold the stock market back. I think we've already seen that the market peaked for the bull market, this bull market on July 31st. That doesn't mean I think we're in a bear market. I think we're in a sideways or correcting market. Could be a pullback of something like 10%, which would be down to the 200-day moving average. Now we're sort of at the 50-day moving average. So let's have some fun and look at these charts again. Let's move on to, okay, so here's the conflict we have in between the two disinversion scenarios. It's not just what the Fed is going to do here in terms of keeping rates up or bringing interest rates down, but clearly the bond market now suddenly is concerned about the deficit. I have been asked often in the 40 plus years I've been doing this, why I'm not more concerned about the federal deficit. As you probably know, I tend to have a bias towards optimism. I try to be realistic, but I tend to be realistic in an optimistic way. And so more often than not, over the years, I've had conversations with accounts who have listened to the bears and gotten concerned about particularly the federal deficit. And they asked me, so why aren't you more concerned about the federal deficit? My answer has been, well, first of all, federal deficits tend to widen during recessions when interest rates tend to fall, when the Fed starts to lower interest rates, and that actually tends to be a buying opportunity in the stock market. The other thing I've said is, look, I'll become concerned about the federal deficit when the markets become concerned about the federal deficits. We've had some of our best bond rallies when the deficits have really widened, again, because recessions bring down inflation and cause the Fed to lower interest rates. This time is different. This time we're seeing this federal deficit widen dramatically from $1 trillion on a 12-month basis to $2.3 trillion on a 12-month basis through July. And what the heck's going on here? What's this up and down? Well, that up and down is attributable to government outlays really moving higher, and at the same time, receipts moving lower. We know why the outlays are moving higher. The Biden administration and Congress passed a bunch of very stimulative spending packages that are kicking in now. But what's strange is why are revenues coming down? Are the hardlanders right after all? I don't think so. I think you have to recognize that maybe this weakness in receipts has something to do with the strength back here. And I think the strength back here over the past years, last year particularly, had to do with people panicking out of the stock market, cashing in some pretty substantial capital gains that they've accumulated over the years, or certainly since the pandemic low back on March of 2020. And so I think that boosted tax revenues, and now that's over. And so the tax revenues are sort of going back to something more normal. So, we couldn't count on this continuing. This was probably taxes on dividend, on capital gains in stocks. And that's now normalizing to something more along the trend line. So we do have a serious problem with the deficit. Its outlays taking off, receipts not going the other way. And as a result, there's a supply-demand issue that the bond market's dealing with. Usually supply and demand don't matter. Deficits don't matter during recessions, especially since during recoveries, revenues make a comeback, and we haven't had we've had profligate fiscal policy, but nothing like what we're seeing now. And I'm being objective here, not political. In addition, we've got this mess, which is increasingly outlays are also being driven by net interest paid. So the bond market now, I think, has reason to care about supply and demand. And on the demand side, the story doesn't look all that healthy either. This, by the way, is various measures of the government debt, all-time record high. Well, we know that the Fed is cutting back through QT and its holdings by about $60 billion per month in U.S. Treasuries. I think, if the Fed's starting to get concerned about a disinversion scenario that's not a happy one with bond yields going up, I think they may want to consider, they may have to consider at some point suspending QT, because that's obviously not helping the matter. But on the other hand, if I'm right, and if they seem to be moving in the same direction as I am, and that inflation really is turning down quite substantially, then maybe that's all we need, is just to see inflation come down to stabilize the bond market. But meanwhile, on supply demand, the demand side, the banks are cutting back their purchases of securities. We have U.S. Treasuries and agencies. We don't have separate data for Treasuries, but clearly they are going down, not because the banks are selling, but because the securities are maturing, and they're letting them roll off, in my opinion. This is not a happy chart. This is net foreign purchases of U.S. Treasury bonds and notes. This is what the private foreigners are doing. It was pretty happy up until now, where we saw foreigners buying to the tune of $1 trillion over a 12-month period, all-time record high. But this looks set to moderate. It's hard to forecast these international flows. Maybe something will happen that'll make people feel that they have to run to safety back in the U.S. Treasury bonds and notes. But certainly this looks like it's peaked, and that's not going to offset some of the supply issues and the QT issues that the market is facing. Well, let's look at inflation. Inflation is the happy story, in my opinion. The CPI came out, and right away there was the pessimist taking, well, take out core, make it core, take out food and energy. And the July increase is 4.7%, still well above the Fed's 2%. And some Fed officials like Mary Daly said, we still have our work cut out for us to bring inflation down. But I have been pointing out, and as you know, that if you take out the CPI's headline, take out shelter, you get 2.0%. I mean, it's been a complete symmetrical round trip in the inflation rate, excluding shelter. Look at core shelter, and it's higher, but it's still under 3%. It's 2.5%. That's pretty impressive. And I think we all know that shelter inflation, the way it's measured, particularly the big rent component in it, is a laggard. We know that rent on current leases has come down really quite dramatically. And so I think we can pretty well count on rent inflation and shelter inflation continue to moderate significantly over the next 12 months. So I think maybe the Fed really needs to kind of focus on this kind of number to really make the case that inflation's coming down. But of course, they want to maintain their credibility. They want to make sure that they don't hype up how much progress we made in inflation. They certainly don't want to say mission accomplished. That would be a jinx. But how about the PPI? The PPI inflation rate also total demand is up only 0.8%, a total round trip. Look at goods, minus 2.5%. It's actually negative deflation. Services, 2.5%. Again, people looked at the services in July and said, well, wait a second. Look at that increase in services at 0.5 on a month-over-month basis. We still have a problem in services. 40% of that was a bizarre 7.4% month-over-month increase in portfolio management fees. I guess brokers did pretty well in July on a month-over-month basis. It's kind of strange. It looks like an aberration to me. But I'm looking at the CPI and PPI and still seeing disinflation. Contributing to disinflation has been our story, which now is widely recognized, that if China goes into a deflationary recession, we don't have to go into one to bring inflation down, certainly not in the goods area. And so here's China-U.S. import price index, the red line, and you can see that it's in a deflationary setting. And then we compare that to PPI, final demand for goods. We're not going to put services in there, obviously. So this is ex-food and energy. We don't rely on China for food and energy, but you can see that that PPI inflation rate is down to 1.9%. And then take goods for the CPI, ex-food and energy, then you got 0.8%. Don't worry, be happy, right? Let's sing that happy song. Well, it would be nice to sing that happy song, but again, we do have this issue with the bond market, and the bond market here is consolidated right below 4%. Now it's back above 4%. I don't like looking at these kind of consolidation patterns because they either go down or they go up, and this kind of worries me that it could go up if things don't play out right. This week, I think we're going to have a batch of weak economic indicators, retail sales, industrial production, the coincident economic indicators, leading economic indicators are all going to kind of remind us that while the Atlanta Fed's real GDP model is saying that we're tracking at 4.1%, maybe that's a bit of an exaggeration relative to what is actually happening. And so I'm actually rooting for going back to talking about a soft landing now that people are worrying about no landing and a reacceleration of economic activity. But this is why the bond yield, the nominal yield has gone up, the real yield has gone up. And again, this is worrisome because we have been at a period of 2% real yield for the TIPS yield. You get to 2%, it wouldn't take much to get to 4.5%. If you look at the spread between the nominal and the real, this is where we are right now at 2.36%. We get to 2.5% plus 2% on the real, and there you have it, folks, 4.5%. We're pretty close to all that happening. I think that we get above 4.25%. I think the stock market isn't going to do very well with that kind of number. And already we've seen some of the areas where the valuation multiples have been elevated, particularly the mega cap 8, have been brought down by this drama suspense we have in the bond market. So I'll be watching the surprise index. The surprise index, economic surprise index, has been surprisingly strong. And as a result, we've seen the 10-year bond yield go up 63 basis points over the past 13 weeks. I'm expecting that this surprise index is going to start coming down, and that will stabilize the bond market. You may get the sense that I'm rooting for the bond market to kind of level out here or go down rather than keep going up above 4.25%. I mentioned before the federal tax receipts. You can really see that the payroll tax receipts all-time record high. But look at this. You had this surge to record high in individual income taxes, and that's important in recognizing why personal income taxes on a 12-month basis have been coming down, because this was the aberration. This isn't the aberration. This is this coming back down to trend. This is not necessarily an indication that the consumers suddenly are having problems getting income and therefore are paying less taxes. We're not going to the consumer-led recession based on this. So it's important to put that in the right context. Well, that's the context I wanted to cover. Let's turn to the Q&A. I have a few questions. Thanks. Some of you gave me feedback that my previous mic was terrible. So now I'm a very proud owner of a Yeti microphone. And let me know if you got any problems with this one. It seems to work pretty well from what I gathered. Also, some of you mentioned that you wanted to see the charts a little bit larger. So I hope that's worked out for you. And then let me know if you have any other suggestions. We keep this pretty basic. So there's no Hollywood production, obviously, in what we're doing here. We're just trying to have a conversation with you and convey the information we think is relevant for the week ahead and beyond. So what do we have here? Anonymous. Hi, Ed. Sorry to bother. Could you please zoom out of the PDF? Oh, now you tell me. Sorry. So the PDF was too zoomed in. Okay. Sorry about that. Now I'll have to find some happy medium. Michael, can you please provide another primer on the bond vigilantes? Sure, I'll do that. I have it in my 2018 book. I covered quite a bit of it, but yeah, we could do that again. Cactus, if 10-year Treasury yields get to 4.5% or so in the coming weeks, would that be enough to get S&P 500 to test the 200-day moving average, or would we need more for the 200-day to be tested in your view? I think that could do it. I guess one of the puppies decided to leave while the other one's still snoozing. Yeah, I think that, I don't know if it would get us all the way down to the 200-day moving average. I mean, that's like 4,100. That's pretty significant drop. Altogether would be a 10% drop. So it'd be sort of a garden variety correction. So it'd be possible. But you know, August, but particularly September, have a bad vibe for the stock market. And you know, that's why I like asking Joe Feshbach for his trading view, because sometimes his way of looking at the market kind of makes me think about, well, for him to be right, what would have to happen on a fundamental basis? And so you're sort of asking me the same thing. What fundamentally would have to happen to bring us down to kind of reverse engineering as well? What would have to bring it down to 200-day moving average? And yeah, I would think if we get to 4.5%, you'll see Ackman and lots of others who are short the bonds, letting us know that the yields are gonna go still higher, and that might be enough to kind of spook people into being even more cautious in the stock market. What is portfolio management? Portfolio management is a price in the PPI for the cost of portfolio management. That's all it is. And it's to see it going up 7.4% month over month is bizarre. So I would think that it's an aberration, and certainly the PPI inflation rate, instead of being 0.3 overall, might have been more like 0.2 without that one strange component. Okay, we're doing good on time. We've got two more questions. Robert, vacancies in office buildings everywhere. Could we have a commercial real estate bubble ready to burst? Effect on financials? Yeah, I think you know, I've been arguing that with the pressure from the bond market, we may want to underweight, or at least take some profits in the high-flying information technology and focus on energy, financials, materials, and industrials. Feeling pretty good about industrials, quite good about energy, the way things have played out recently. Financials is a little trickier, of course. In a happy disinversion scenario, I think the financials would do fine. That's where short-term rates and bond yields go down, because the Fed's easing or expected to ease going into next year, because people come around to my view that inflation really has declined substantially. I mean, we're looking at it under 3% for the CPI, core and headline, excluding shelter. And we know shelter is coming down. So what's, anybody have a problem with that? I don't. I'm happy with it. But, there's still plenty of people who don't see what I see or don't put the same emphasis on what I'm seeing. So look, the bubble in the office market has burst. That's clear. It really started to burst with the work from home phenomenon. But now that people have to pay, I was hearing one of my dogs knocking on the door. But now that they have to pay a lot more to refinance their mortgages, that a lot of them may just walk away from their properties, and that creates a problem for the banks clearly. So all the more reason for the Fed to start working to keep the bond yield from going up. Could it affect the financials? Of course it could. I mean, I think that's one of the reasons Moody's downgraded several financials, and they said that they may not be done, and they would be justified in cutting some more if in fact we start to see some really big failures in the office building marketplace. There's some that are being restructured in their financing. There's some that are being torn down and rebuilt. The land is worth enough. There was one that I mentioned in Santa Ana, California, where a newly renovated 2-office building complex is being torn down to build a logistics center. So never underestimate the ability of capitalism to solve solutions, to restructure things. And again, a lot of these loan losses are going to be in portfolios rather than at the banks. So that's something to consider. I'll take one last one. Breadth has been notable of late with the equal weight S&P 500 relative outperformance of the market weight S&P. Why the 4,600 year-end target with rates topping out? Yeah, I mean, I'd be happy to say that things are going to work out better. I just, look, I was targeting 4,600 by year end. We got there at the end of July, close enough. And I could have raised my number to 4,800, but I felt that, we may have some issues with the bond market. Remember, one of the reasons that the market rallied was because people started to realize that we're not going to have a recession after all. And then in the bond market, say, well, if we're not going to have a recession, then maybe we shouldn't be doing 3.3, 3.5% on the 10-year. And so here we are at 4.2%. And we have, in fact, seen the mega cap 8 stocks give up their valuation multiple from 30 down to 28. Could go still lower. They account for 26% of the S&P 500. So all those are sort of whirring around in my brain. And I came out with 4,600 by year end is still my target. And with regards to the outperformance of the, we've been arguing that this thing should broaden out with some of the other sectors I just mentioned doing better. And a lot of those sectors are basically value outperforming growth. So I have no problems with that, but it doesn't necessarily mean that we make a new high in the market if value goes up and growth goes down. I'll take one last from Chip. And it seems you are viewing cyclicals positively. Yeah, industrials are certainly in my overweight. So I've gone a little past my time as I usually do. I want to thank you for tuning in. Have a great week. The suspense is killing me here with the bond market, but you know where I'm coming from and what I'm thinking. Thanks a lot.